Hi, welcome to today's Technically Speaking Tuesday. It's our video update for, well, the markets and what's going on. Today's Technically Speaking post has already been emailed to you, and of course, I suggest that you do read this because we are talking a lot about what's happening in the markets currently. Obviously, big sell-off day in the markets today. Something that we've been discussing was a potential. Today it actually showed up. So today Richard and I are both going to discuss a little bit about what's going on in the markets currently, what does all this mean, and what are we going to be doing next. First of all, let's step back and just take a look at the chart for the year. Now, this is the SP 500 going back to January of this year. Here's the January rally, the sell-off in early February, the rally all the way back to all-time highs that happened earlier, and then, of course, this recent sell-off. The one thing we've been talking about here importantly is that this is the first time that the market's actually broken below the 200-day moving average. Up to this point, sell-offs back to the 200-day moving average, this yellow line, has been an opportunity to add exposure to portfolios. This is the first time that we've actually had a significant change in the markets in terms of actually breaking below this average. Now, what does that mean? It does change the dynamic. Up to now, we've just simply had a correction from highs. And yes, while it seems painful that we've had this correction, it's really been nothing more than just volatility in the markets and a bit of pickup. Now, this is the month of October. We talked about the risk of higher volatility in the month of October. Of course, we also have the seasonally strong months of the year coming up in November and December. Stock buybacks will be coming back online at the end of this month. Of course, we'll also have portfolio balancing heading into the end of the year. And of course, a lot of performance chasing by mutual funds and hedge funds to try to catch up with the market. So there is some impetus for a rally back later on this year. So we want to be careful not to eliminate too much exposure currently because, again, we don't want to react to simply just a corrective process in the markets. Again, we have not even gotten to a 10% correction yet. That would require a retracement all the way back to the February lows to get to a 10% correction, which is entirely normal within any market environment that we have around. One thing that we've done within our portfolios since really January this year, we've been underweight a lot of the areas that have been most at risk. Emerging markets, international exposure, industrial markets, as well as basic materials. Those have been under a lot of pressure. We've not had exposure really to those areas, so we've benefited from that. But again, we had to have market exposure for this rally. So again, a little bit of volatility here. Certainly understand that that's a bit concerning. But let's step back here just a little bit more and take a look at this on a weekly basis because, again, when we look at this on a weekly basis, this is the SP 500. The yellow is when the markets are extremely overbought versus extremely oversold. Whenever the market has been this oversold as we are now, those have typically been periods that you at least get a bounce in the markets. Again, I'm not saying that just because you're oversold, you're going to rally at all-time highs, but we also want to be careful from a management standpoint that we don't simply get emotional here and sell a bottom. A lot of the stocks and fundamental indexes that we own are fine. They're fundamentally in good positions. And with an oversold condition here, we're likely to get enough of a bounce that we can then reduce risk into. Now, where is that bounce going to get us to? Well, that's the million-dollar question that we don't know. But this is a long-term chart of the markets going all the way back here to back 6 years. And as you see here, here's the 2015-16 bottoms in particular. And when the markets were as oversold as they are right now, that was where we actually bottomed in the market and began the next leg of the advance. Again, here we are below the long-term moving average, so a rally back to some level of support that fails, and so this would be a rally back to that 200-day moving average. Currently, that's around 2760. We're currently trading about 2700 in the markets as we're talking about this right now. So a 60-point rally from here gets us back to that resistance level. If we fail, we'll want to take some money off the table. Again, kind of reassess our positioning. And again, if the markets continue to rally above that to the end of the year, we can always add equity exposure back to the portfolios. Importantly, and this is what Richard and I are going to discuss a little bit more here in just a second, is that we just want to manage money tactically. We don't want to react emotionally to these very sharp sell-offs, which can occur. We've warned that this was a possibility. It's now happened. You can't really dictate and plan for very sharp sell-offs. We have to kind of work our way through. It's a process, and that's a process that we're currently watching very closely. Richard?
Yeah, why does it feel so bad though, Lance? I mean, you think about how we've been dealing with it and our emotions.
Right.
This feels like you said off the high. We're about 7% off the high.
Right.
Corrections of 10% are fairly normal and healthy.
Right.
So we have nothing really to panic. Watch yellow signal, but nothing really dramatic that we need to do.
Right.
Why does it feel so different?
Well, because we haven't had this kind of volatility before. I mean, outside of really January, remember in 2015 or 2016, we went almost 14 months without a correction in the market at all. Right? Not even a 1% correction.
Nothing.
So we got such a long period of a very low volatility advance all during the 2016 year and really into 2017 that people got very used to not having volatility. So now, and we've written about this before, is that when you have a long period of very low volatility, when you have a pickup of 4 or 5% and a sell-off, it feels like a 10 or a 20%. This isn't a real correction. We haven't even hit real correction levels yet. And again, which is why we want to be careful about making emotionally driven mistakes, because importantly here, if we take a look at the markets and just look at a long-term trend line, we haven't even violated the uptrend line, really going all the way back to 2016 on a weekly basis. So again, we just want to be careful not to overreact and make mistakes in portfolio management. Again, we've had a bit of a sell-off here. Yes, it feels worse than it actually is. But again, this is where we need to start making decisions if we get a bounce in the market.
Yeah, and the other thing I think is important is bonds have always been hated, right?
Yeah.
We all these talk about bonds are the worst thing in the world. We own bonds, right? And obviously they haven't been responding. But what are you seeing with bonds today? Are you seeing more of a better or a reduction of yields, or bonds doing what they should? Let's say, are bonds doing what they should be doing when markets pull back?
Yeah,
like
see,
this?
that's a very important issue, because again, one of the differences that has gone on this year in particular is that normally what happens is that when you have a sell-off like you had here, money rotates from stocks into bonds.
Right.
So the 40% that we own in bonds, it picks up the slack, reduces overall volatility in the markets, and of course the market's down 5, and your portfolio is down 1 or 2 because of the pickup in the bonds. What happened this year in particular, because of the Federal Reserve hiking interest rates, we've got dollar funding issues that are going on right now. You know, this whole trade war situation with China is impacting the ability for us to sell treasuries. Of course, our government is now issuing, we're running $1 trillion deficit. We're going to have to issue about $1.5 trillion in new debt next year. The question becomes who's going to buy it. And so what's happened here is really this year, because of this massive deficit that we're running, and at the same time we're also reducing federal revenues because of the tax cuts, bonds have not been working like they should. So we're getting these sell-offs, but bonds aren't participating by getting a rotation of money flows. So we haven't gotten and this is a rare event. This doesn't occur very often.
Right.
And this is not likely to be the case. If we do get into a much broader sell-off, I would expect money to rotate into the safety of treasuries for simply not having a better place to go. And the great thing about treasuries now, as opposed to where they were before the Fed started hiking rates, is that yields are now at a level that's higher than the dividend yield on the S&P. So there is now an alternative to stocks. So I would expect that if this acceleration in the market continues, we get a bounce that fails, we're going to lift some exposure, raise some more cash in portfolios. That cash is also a hedge. But if the market does decline, expect a rotation into bonds, because you'll see that as a pickup of safety and also an increase in yield. And look, and here importantly today, you are seeing that rotation. Bonds are actually doing very well today, despite the fact that they've had a really tough road over the last couple of weeks because of this push up by the Federal Reserve, because of interest rate issues. You are seeing this actually work today with the sell-off in the S&P. You are seeing a nice pickup in bonds that's also helping offset some of the decline today.
So yields have pulled back. So this might be a bit of the fear that's helping to move some of that money into bonds that we haven't seen.
Exactly.
Right.
And now if it continues, and I would expect that if this fear continues and we get a further sell-off in the market, that you're going to see more of a rotation. And look, and on TLT as an example, which we're looking at here, you're looking at a move from about 114, which was a level that we targeted in our newsletter a couple of weeks ago, to about 119 back on TLT, and that would just be a normal trade here. So you could see a big pickup in bonds over the course of the next several weeks if we get a further decline. I would expect a rally in the market first, to give us an opportunity to raise some cash, and then be watching bonds. Of course, we've done a lot to shorten the duration in our bond portfolios, floating rate funds, short duration bond funds. So we've eliminated not a lot of the interest rate risk. So what we'll look for here is a push up here that will actually benefit the intermediate duration stuff in our bond portfolio.
Well, here's the weird thing about the stock market, because all the economic numbers look pretty good, right? And unemployment, job openings are at the lowest level in how many years?
Right.
We were in diapers.
Yeah.
Or we were young, right, at the time.
Younger.
And yet, at the same time, the market, I think, is more of this sophisticated crystal ball. What is it seeing, even though these numbers look great, that's troublesome on the horizon? What's the market telling us today based on the fact that all the numbers look good?
Yeah, well, a couple of things. First of all is that when you take a look at all your economic indicators, consumer confidence, investor confidence, employment numbers, jobless claims, they're all at record levels. Okay, well, that, and first of all, is an issue that you should be concerned about. When things are at record levels, those are records for a reason. That's where we were at the peak before, right? So peak jobless claims, peak employment numbers, peak confidence. The reason it's a peak is because that was what marked the top. Peaks of employment or economic data don't suggest the start of a cycle. It's what dictates the end of a cycle. Now, here's an important point about this, though. The stock market is a great leading indicator of what is coming through the economy. So you take a look at like 3M's earnings today, you start digging down into what they're reporting. The economic outlook is weakening. It's not getting stronger. As we talked about in last week's newsletter, is that a lot of the impetus to this economic growth we've seen in the first couple of quarters has not been from this resurgence of economic activity. Far from it, actually. What you're seeing is a residual or the effect of 3 massive hurricanes last year, $60 billion worth of investment into the economy. Your jobs were in construction, manufacturing, commodities, etc. And you've also had a massive amount of fiscal spending since the beginning of this year. And of course tax cuts, which went to boost share prices, etc. So we've got this illusion of economic growth, but we don't have sustainable economic growth, and the market's starting to figure that out. So these last 2 hurricanes, that's going to put about another $50 billion in the market, may extend out some economic growth for a couple of quarters, but the market's already starting to sniff out that this is starting to weaken more. Now, also remember, with all this economic data, this is an incredibly important point. The market tends to predict what's happening with the economy about 6 months in advance. Before this economic data turns, the National Bureau of Economic Research and the BEA will come back and revise all the current data. Likely that data will be revised lower than where it is currently. There's a lot of indicators that suggest that will be the case, and we won't know that for about a year. Remember, in December of 2007, we wrote an article talking about why we were about to be in or were already in the worst recession since the Great Depression. Of course, economic news was great. We were at peak economic numbers. Employment was fantastic. A year later, all those numbers were revised back 12 months to show that the recession actually started in December of 2007. So that's the problem with economic data, is the negative revisions, and which is why we watch the trend of the data. Is the trend of employment rising or is declining? It's actually declining. So you take a look at the economic data. A lot of that economic data is trending lower, even though it's still positive. So always watch the trend of these numbers.
So the last thing is, obviously we have a sale discipline at Clarity, and that's great because we have an extraction process. But if people would ask, hey, when does that kick in? How does that work? Because there's levels of what we do. Right. So as you said, as money managers, we're managing long-term money, but we're managing risk along the way, and we don't want to make any really big knee-jerk reactions, obviously.
Exactly. So then that's a great question. So where would you sell here? The problem is that when we get to levels where typically you would sell and liquidate holdings, etc., it's not up here, above moving averages and above major support levels. We have to wait and break below that and get a signal that, okay, something's changed within the market dynamic. Well, as we've seen here, just in the recent environment, we broke the 200-day moving average here. Okay, so there's your signal that we should be selling some stuff, but we immediately rallied right back above it. We had the huge rally last week.
Right.
And it was really just yesterday that we actually got a confirmed break back below the 200-day moving average just yesterday.
Yeah.
So we now have a reason, and we now have the indication that we now need to start selling stuff in portfolios, right? So, you know, we've already made a list of things we're going to be reducing: small cap, mid cap. We don't have any international emerging markets. We don't have any base materials and industrials, and a lot of this is going to be taking profits in things like healthcare and technology, et cetera.
Right.
But we don't want to do that here because we're, again, back to what I showed you earlier, we're very oversold here. So any bounce back towards 2760, 2770, anywhere in this neighborhood of this previous 200-day moving average, we'll execute those trades and raise some cash.
Yeah, I always like to say that if you go to a physician and or a surgeon and they take care of you, you don't want them walking into the surgery room with a machete.
Yeah.
You want a surgical knife. So what we do is look surgically at the weakest positions and then try to move away.
Right.
But to your point, when we get to this level, we usually should see a bounce. And again, it was just only yesterday that we saw a signal that says, hey, warning, we need to watch. And we have a list together.
Exactly.
Right.
All right, if you have any questions, though, of course, for Richard or I, be sure to go to our website, realinvestmentadvice.com. Click the Ask a Question button. Be sure and read today's portfolio update as well. And again, we'll be updating all of this in our weekly newsletter also because, again, while we're talking about daily data here, it's important to understand that we do work on weekly numbers. So where we finish the week is much more important than what happens today because we see these kind of volatile moves where we have quick recoveries at the end of the day, the next day. So those are kind of the head fakes that we don't want to get trapped into either. So again, make sure and grab this weekend's newsletter. I'll be updating all of this and, of course, what actions that we're actually taking here in portfolios. Again, get by the website, realinvestmentadvice.com. Send us your emails. Richard and I happy to help you out, and we'll talk to you next time.